welcome to the Capital Discussions Roundtable. I'm Tom Nunnermaker with Jim Riggio and our guest, Bill Ghauri. Before we get started, a quick disclaimer: the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And with that out of the way, Bill, it's getting to be a great habit to have you back. Welcome. Welcome again to the roundtable.
Okay. Well, thanks, Tom. And let me share my screen here so you can tell me when you see it.
Okie doke.
We're getting a shared screen. We're really glad to have Bill on because we talked a lot about this, that over the last several years, that because of the way the implied volatility at different strikes, we talked about skew and term structure, because of the way things have changed in the current environment, it's difficult to find trades that you can just put on month after month and always make money. So you do need to end up being able to take advantage of being able to, sell things when they're expensive, buy things when they're cheap. And that's something that, Bill and I have talked a lot about, and he's done a tremendous amount of work, not only on the technical analysis, but on the quantitative piece of the options pricing and the implied volatility. Bill, how did you actually get started with this? What was the reason or the catalyst that got you started?
In terms of trading options or applying more of a technical approach or analytical?
Right. The technical and the analytical approach.
Yeah, well, I spent a lot of time actually doing a lot of building a lot of Excel models and doing financial analysis of different types of really large infrastructure projects. So I had a lot of experience applying technical and financial parameters to problems and coming up with basically model results that would tell our investors whether or not a particular project would be worthy of an investment. And so I kind of had this background. So I did have an interest in options for quite a while, and since about probably the late 90s. And then it was maybe around, 2005 or 2006, I did Dan Sheridan's program, and that's when I kind of got, I thought I knew a fair amount about options until I took that program. And then after I took the program, I realized, boy, that was only the beginning. As most people know about trading options or trading in general, it's a never-ending educational process. I mean, you can learn new stuff all the time. So in any event, I started applying a technical or an analytical approach to options, and I really sort of gravitated more towards trading directionally. I started out trading non-directionally by putting on positions that when it was within a window, a DTE window that looked pretty favorable, I'd put on a position, and I'd try to get a fairly balanced position in terms of the deltas. But I found that over time that I was doing better by actually spending more time watching the market and looking really at price and volatility movement, and then identifying those extreme points, because I found that the premium difference between just putting on a position randomly versus waiting for an opportunity when the volatility is at an elevated level, that you could get much more premium. And so I started focusing more on a directional strategy where I would be identifying these extreme points to enter trades. And I built some tools to kind of help me do that. And so that's kind of kind of how I have sort of become a directional trader by applying technical analysis to the underlying price and volatility. And because see, underlying all of this, I'm still an option trader. I'm positive theta, and which is a wonderful thing. That's why I say I love options, is because you don't have to be 100% right, and you can still make money. Now, more recently, and probably the reason why the alpha service has really sort of become, what as you and I have discussed about becoming a service, is that in a lot of my recent back testing, I've been able to quantify the risk and money management plans that I can use with the technical analysis. And it was really sort of through that research that I kind of shifted this more into high gear. And I would have to say a lot of it is because of what I learned about the risk and money management. And as you'll see, I'll post a trade log of some recent trades, and this kind of emphasizes my point about applying consistent risk and money management. And so I guess that's a long-winded answer to your question.
Well, I want to get started, but I do want to end kind of making sure everybody heard something I said early on. I don't know if everybody's talking about technical analysis that for our clients. Bill has been doing this for a long time, and he was basically the quantitative programmer that programmed it for directional funds. Could you just give everybody a little bit of background about what you had done for some of the very large, just a brief overview of what you had done, then let's get started, please.
Sure. I did some work for actually as a private equity fund that helped them build a back testing model where they were trading a basket of different futures, and it was very heavy on the risk and money management piece. In fact, it was actually through that engagement that I really sort of learned that, hey, this is something I really need to apply to my own options trading. And so I worked with a team of two traders, and they were programmers as well. And between us, we put together basically a back testing program that fit their need. And it was a very interesting engagement, and it as I said, it really kind of cemented the whole concept of risk and money management. Well, I should say actually my own back testing with the options really cemented that in my mind, that is so key. And one of the reasons why I presented that, I did that first presentation about what back testing taught me about risk and money management, is I felt that was something that is you just don't see it too much or hardly at all in the options community. I mean, you just don't see it. And so so that was one of the reasons why I did that first presentation. But anyhow, that's kind of my experience with some of the modeling work that I've done with some of the larger equity funds.
So why don't we get started?
Okay, well, good. So we're launching a service today. It's called Alpha Service. And basically, this is a very quick presentation. It's about 10 slides. But we'll just give an overview of what the service includes, what the signals are. I'll speak to the model and actual trading portfolios that I'll be using. One will be in a PM account and the other will be in a Reg T account. I'll describe some of the reports and technical analysis that will be provided, and I'll talk about some of the software tools that will be coming in the future, and then we'll sum it up. So basically what the service is going to provide price and volatility signals for directional option trades. So what the subscribers will get is specific strike and expiration selections to either buy or sell puts or calls, or in the case of the Reg T account, there'll be vertical spreads in the SPX. Also, with each trade, there'll be a risk and money management plan for both portfolios, which again is a PM account and a Reg T account. Also, they'll receive weekly open position reports, so you'll get to see exactly what's on and all the P&L and the Greeks and everything else for open positions. A weekly technical analysis review, and what this is going to be some chart analysis that I'll do and post in on the Capital Discussions website for the subscribers. I'll do a weekly WebEx session where people can ask some questions and we can go over what happened during the week. And then when a expiration trades have closed out, I will provide the trade logs and the portfolio metrics so that people can see how those are, how we're doing over time. And then periodically, I'm going to do some presentations on how to apply technical analysis to your options trade and also how you manage your options account. At least how I do it, and I think there's a lot of opportunity to teach option traders how they should look at their options accounts. So the signals will basically involve sending the subscriber an email and text alert with the specific strike and expiration, the quantities of the single options or spreads, and these are, most of the stuff is going to involve selling options because we're theta positive traders. And the positions are going to be sized based on risk. So this information in terms of how many contracts to sell will be included in the trade alert. Also included will be the stop and roll price alert values, as well as the profit target alert values. The frequency of the alerts is going to really depend on the market. I mean, this is a case of where patience is key. You just have to let the market come to you rather than you chasing the market. And what I mean by that is that I'm looking for certain levels of volatility before I even think about selling premium. For example, today, I think the VIX got down to around 12.75 or something like that. I mean, it's under 13. I can tell you that this is not the time to be looking to be selling premium. At least this is not the time for me to be looking to sell premium. I like to see a certain floor value, and we're not there yet. So the frequency of the alerts really just depends on the market. I look at both the volatility and the underlying of the ES. I follow the ES, the futures. I trade the SPX, but I follow the ES. And so sometimes, several days can go by, and often, well, not often, but there have been times where a couple of weeks can go by without getting a valid signal for a long or a short trade. I'm going to use two portfolios. One is going to be in a PM account, and the other is going to be a Reg T account. Now, in my PM account, I'm going to allocate $100,000, which will trade mostly single naked SPX options. And most of those are going to be puts. Sometimes I'll do calls, but by and large, they'll be puts. The Reg T account will have $25,000 of allocated capital, and that one will trade SPX spreads. Again, mostly put spreads, but sometimes call spreads, but mostly put spreads. As most people know, the market has a tendency to go up. I mean, the bias is up, and it probably goes up about 70% of the time. I mean, we've been a confirmed uptrend for several years now. It takes a lot for the market to turn to a point to where it's what I would say at a point to where I would be comfortable selling calls, naked calls, or call spreads. So as long as we're in a confirmed uptrend here, by and large, we're talking about selling puts and put credit spreads. So then every week at the end of the week, I'll send out the open position report for both accounts. the ES chart for the S&P futures, annotated with some notes and the technical analysis, and also the VIX and RVX histograms. Now, I'm not going to be providing anything with regard to the RUT price analysis, but I will provide an RVX histogram for people that do trade the RUT. They can at least see where the price of the RVX has been over the last 90 days to help them have an idea of where's a good, where's a good floor value to be looking at in terms of selling premium in the RUT. So also I'll be sending out whenever the trades are closed, I'll be sending out a detailed trade log for both accounts. Also a running log for which I actually have I can show one that I've done since I started doing this in the SPX, which basically shows some of the key metrics. And then, of course, our WebEx session, and then the periodic stuff, some research, because I continue to do some research of different systems, and as I do that, I will share that with the subscribers. And then finally, there's some software tools that I've developed to help traders, option traders, analyze potential opportunities, and also track and analyze and report on open and completed trades. And I've developed these and have used these actually for a number of years, but I'm converting these over into a more distributable form. And so once I have those in a distributable form, we will make those available to the subscribers. And so the Alpha Service subscribers will get access to those initial tools as part of their subscription fee, so there'll be no additional charge. One thing I will mention about the software tools is that they rely on RTD, which is a real-time data, which is only supported by PCs. It's not something that's supported. Macs do not support it. So initially, these tools will be what's known as XLL add-ins for Excel running on a PC. And then finally, we've basically priced the service the same as the other services within the Capital Discussions offering, $119 a month, $300 per quarter, and $550 for 6 months. And so with that, I guess one of the things that I did want to show is I had mentioned about here's how actually I wanted to show this so that people could see. These are actual trades that I've done just in the last 5 weeks or so in the SPX. And what I wanted to show is how this methodology of trading and applying risk management essentially works when you're a directional trader. You're not always right, but hopefully you're going to cap your losses when you're wrong. And then when you're right, you're going to have some pretty good size winners. So if people do recall the presentation that I did, I guess it was the second presentation I discussed risk-reward ratios for selling options. And what I do is primarily I set a stop value that generally is around a 1.2 multiple. So in other words, if I sell something for $10, my stop on that is going to be $12. My target profit, I like to get anywhere from about 0.8 to 0.9. So if I can capture 80 to 90% of the credit that I've received, so that's good enough. And I use some technical analysis that if I see, hey, I've only been in the trade for, so many days and I've captured 80%, then I may just go ahead and take it. And in my back testing that I did, what's very interesting is that in the back testing that I did, I found that the days in trade, like for example, we'll go through some of these here. I did a trade here. I entered the trade on the 4th of March. I had to roll it actually 2 days later. I had sold the 1975, and at that point in time, that was 44 days to expiration. I sold it for $13. I had to buy it back for $15.65, so I took a loss of $2.65. Well, I ended up rolling that 1975 to a 1950, which I ended up having to roll again 5 days later. I sold it for $12.25, and then I had to buy it back for $15.42. So that particular trade, I ended up carrying it through, and that was in April 1950. And actually, I'm sorry, I had to roll that one again, and it then closed out. Let me find it here. This the 1950 here. Okay, here we go. I rolled that to a 1925. This is organized by exit date. That's why it kind of threw me off here a little bit. So this 1950, I rolled again to the 1925. So you can see here, this one actually was rolled 3 times. But so we took a loss here, but then we ended up making 1955 on that. These 2 were rolled, and then we made pretty well. So in any event, and you can look at the chart and follow along because you can see the entry and exit dates. But this is what I was going to say, is that when you're in a trade and it tends to, and you haven't, when you've been in the trade and it's not working out for you and have to roll it, you tend to be in the trade a fairly short period of time, 2 days, 5 days, 1 day. But then when the market does turn around and you get some mean reversion and volatility and it starts working your way, then you tend to be in the trade a little longer, and then that's when you end up making your money. So so any event, this is on a per contract basis. So in roughly, about 5 weeks or so, I captured about 53 points per contract. Lost my thought here. So the one thing that I was going to say is that when in a trade, that when you're following it and tracking it and you're seeing how long you're in the trade, if you've captured a pretty decent amount of the premium in a fairly short period of time, then I go ahead and take it off because that frees up capital and it takes risk off the table. But I do like to wait until I get at least 80%. And if you do the numbers on these, you'll notice that the stops were usually right around 1.2. I think I had this one right here. It was around 1.3. But then all of these here, I was capturing over 80% on all these trades. And so this is really sort of the method of trading. So if you look at these trades, and there's 7 trades, and you're going, okay, 4 winners and 3 losers. That doesn't sound like a great win-loss ratio, but this isn't really about win-loss ratio. I talked about this in my second presentation. It really gets down to how much are you winning when you win, how much are you losing when you lose. And so in my back testing, I found that the system can generally yield around a 60% win rate. And so if you have a 60% win rate with an average risk-reward ratio of over 4, then you can do pretty well. So that's kind of where I'm at so far. And the other thing too that I was going to show is that I think people have seen the histograms that I run every week, and this kind of identifies the floor value of volatility where I like to see. So for example, today, I don't know, we're under 13 or so. I wouldn't even dream of selling premium today. I would wait until we have a better I'd like to see something around 14.5, 15 or more before I start selling volatility. So those are charts that I'll also provide weekly so that people can annotate their own charts for the VIX. And what I do is I just draw a horizontal line around 15, and I just wait for that to get close to that or above it. And of course I look at other things, but that's how I use the floor value of the volatility. Okay, so that's kind of that. One thing I was going to say here on the signals themselves, as I mentioned, the frequency of the signals really depends on the market. Now, the technical analysis that I use, I find that there's a window of about roughly maybe 15 minutes in which to put the trade on. So it's a fairly narrow window. However, there is usually a day's worth of setup that presents itself before that happens, and I'll describe how it generally comes about. You'll see an elevation in the volatility, like the VIX will shoot up. It might be 8 or 10% increase. The underlying, it has a nice down day. What I do is I apply some technical analysis to that, and I can say, hey, you know what, the next day may be an opportunity to be selling some premium. So what I would do is I would send out an alert to say, heads up, tomorrow may be a good day. Now that opportunity may be in the morning, might be mid-morning, might be the afternoon, it may be at the end of the day. But at least I think I can give enough advance warning so that people could be prepared to put on the trades. And then for the strike selection, I mean, I'm generally selling. It depends a little bit on some things such as open interest and where we are with respect to the VIX. I mean, I watch the VIX, I mean, just as much as I watch the ES. I mean, price movement of the S&P is, of course, very important, but it's the VIX. I mean, you're selling volatility. So, I mean, I watch that thing all the time. So it's a combination of those two things. But when I do see the opportunity, I usually select my strike with deltas in that roughly 20 range for the puts, and then for the spreads, I use my spread. I do my spread analysis, and I find spreads that basically give me the best bang for the buck. And that was my third presentation that I did a while back on automated or systematic spread selection. And so I use that technique to actually identify spreads, and those are traded in the Reg T accounts. And so I just wanted to point that out, that there is some heads up, but when the time comes and the text alert comes to say, hey, this is what you want to be selling, you have to act fairly quickly on that. Not to say that if you miss it a little bit, you can't take the trade. You just may not get quite as good a price.
Hey, Bill, it ties into a question Stephen has, is do you always target selling on the quarter strikes for most liquid strikes?
No. I mean, it depends. It depends. If you're doing the naked puts in the PM account, often it is the 25-point strikes, 25-point increments, because they are the most liquid. However, that's not always the case. That you can sometimes get. I mean, I'm not wed to that. But I will say for the PM accounts where you're trading spreads, interestingly, it's those 25-point increment strikes that I think kind of get picked off by the market makers, and those tend to be the worst bang for your buck. So the spreads for the PM accounts are going to be based on really which one gives me the best bang for the buck.
Makes sense. I don't think you showed the URL either for the page, because I know was it Stephen was looking for the price table again. If you want to pull that up, but it's
okay,
also
sure.
on, it's also on that page as well. If you scroll down a little bit. So if you want to go
Okay.
there,
Oh,
right.
yeah. Okay. Yeah. Let's see if I got that. Let me go back to that. I think you had that.
In the chat.
Yeah. Let me pull that up.
Now, there's another question while you're doing that. Any chance to show an example of a chart and you're choosing a strike?
Well, the charts are. Well, I can. Well, I tell you what I would like to do is. I would like to actually provide annotated charts. I don't want to provide some charts right at this point because I have a lot of stuff going on them, and some of that stuff is proprietary, and I don't want to actually reveal that. But this is why I was going to be providing the charts as part of the weekly chart analysis, is because I can actually annotate the charts and explain things so I'd rather actually do it in that context.
Makes sense. And you're going to start this next week, right? The first signals will be like on Monday, if there are any.
Yeah, if there are any. Yeah, it like as I had mentioned, it really does depend on the. Okay, here was this what you. This is Tom put together a link for the service. I'm not sure if it's actually up, if it's live yet, but people will soon be able to read this. Actually, I do have the chart in there about some of the recent trades, and then so this really, a lot of this comes from today's presentation. So it's pretty much taken right from there. So in any event. So people can look to that. They don't necessarily have to have this presentation because most of it's right there. So
from your experience, what kind of frequency would you say on average over a whole year? What would people expect, like on a monthly or quarterly basis? How many trades do you think you're putting out?
Well, you know what I try to do is first off, my DTE window is basically 40 to 65 days. That's what I like to trade. In fact, if you even look at the one that here, if you see the DTE here of these trades, they fall right in line with that 45 to 60 days. I mean, 40 to 65 days. Some a little less. I did this one at 37 days, and I did this one at 66 days. But generally speaking, this is the range that I like to look at. Now, again, I'm looking at identifying extreme points in terms of price and volatility in relative terms. I mean, obviously, you can be in a nice uptrend and then get a nice 2-day pullback, and that could be an opportunity to get in. It doesn't have to be, a pullback to the extent that people are saying, oh gosh, are we going to be going into a correction? It doesn't have to be that extreme, but relatively speaking, you're trying to sell premium at elevated levels, because it's like when the volatility spikes up, it's a great time to be selling your puts, because basically everyone wants to buy them and they're pushing the price up. So it's like buying hurricane insurance for your beach house when the hurricane's already forming and it's only 50 miles offshore. Everyone wants insurance. If you don't have insurance, you're looking to buy it, and that's when I'm selling. So it's you're looking for those points where it's elevated, and so. But back to your question, Tom, about how often, I generally find that I can get one trade on per expiration month. Now, sometimes I am lucky and I can get it on early enough. Sometimes I can even get 2 trades on within the same expiration. In fact, here's an example right here. This trade here that I put on the 10th, okay, that happened to be 66 days to expiration. I sold that put for $21. That was a 1925 put, okay? Well, on May 1st, remember this one here is on the 10th, April 1st, I was able to sell that same one, although I only got $14 for it because that's the difference between 66 days and 44 days. But this is an example of where I got 2 trades on within the same expiration, which I will do. I will do 2. Usually I can't get 3. Usually it's either 1 or 2. But if I can get 2, that's great. So there's a case where I actually did 2 trades within the same expiration month. So it is easy enough to sometimes get 2. Now, interestingly here, this one I did an April trade here, a 1925, 37 days to expiration. I got $21 for it. Coincidentally, I got $21 for the same expiration, but it's a May. So, and you can see too that that's the difference between the 37 days and the 66 days, but they coincidentally were the same price. So anyhow, that. But back to your question again, Tom. I think I try to get 1 to 2 trades per expiration. So over the course of a year, at least 12 opportunities. But if I'm, sometimes more, usually more. So I would say anywhere from maybe 12 to 18 trades per year, probably something like that.
Okay, that's a pretty good number.
Yeah, it's a really kind of a patience game because you have to let the market come to you. You're not really trying to chase anything. You're basically like a sniper waiting, and then when the opportunity is right, you go in. But each time you put on a trade, you're putting on that trade with very specific stops and a trading plan and a position sizing plan. So it's so even if you're wrong, your risk management keeps you from taking a large loss. Now, the biggest drawback to trading this way, and I would say this is probably the case for really any type of for most directional traders, is when the market transitions from basically being a bull market to a bear market. And so, I mean, not that that's a problem when it becomes a bear market, you start selling calls, but the technical analysis that you're using and how you're getting into those trades is basically entirely different. But that transition when the market rolls over, and it takes a while for the market to roll over from, and we haven't seen it yet. We haven't seen it for a number of years. And so, but at that time when it does happen, then basically I'm going to be heavy on selling the calls.
And we did have a question from MK who said, if you watch the ES, why don't you trade it? If you send out a signal for SPX, would that be suitable also to sell futures options?
It would, because I do watch the ES. I mean, that's what I basically chart is the ES. But I trade the SPX. So if someone were trading the ES, then the same. I mean, it's the same signal, really. I like the reason I trade or I chart the futures is because it has volume.
Right.
And volume is something that I look at.
Well, we don't have any more questions. Is there anything else you'd like to say about the trades or your research or anything that you want to add?
Well, not, I mean, I, um, it's, I will say this, is that there's a certain simplicity about this method of trading because it doesn't require, I mean, you actually would not even need an options trading platform to do this type of trading.
Yeah, in fact, I did it that I don't know, a month or two ago, and I found it's very relaxing because I got filled and then I did an OCO to take my profit and also to do my stop loss, good till cancel, let her rip, and you can sleep pretty well at night because your stops are in, and you don't really even have to watch it.
That's true. You can do this with stops, but I will say that I actually prefer alerts, and the reason why I prefer alerts, and if you here, I'll tell you why I prefer alerts is because, well, first off, I'm sitting at my computer and I'm in front of the screen watching the market pretty much, you know, the entire day, Monday through Friday. So I'm watching the market. The thing about having an order in is that if you've ever noticed it in the pre-market or even at the opening of the market, the bid-ask spreads can get really wide. It gets really crazy. And I don't like to, I don't want to have an order that might be close to a stop or a roll point to get caught up in that. So what I do is I use alerts, and I'll set my alert so that when it comes in, when it hits it, but keep in mind too, I'm watching it. And you can set your alerts. If your alert is, if you have an alert to you want to be alerted when the SPX or the, hits, let's say your adjustment is, whatever, 2060 and, it's 2075 right now. And, if you say, well, when it hits 2065, I want to be alerted before when I really need to do something. Yeah, I mean, you can put in alerts to let you know beforehand that, and the other thing too is that if you're watching the market, you'll see what's happening. I mean, if the market closes and you've put on a position and the market tanks that day, but it didn't hit your alert and you're thinking, you know what, tomorrow morning it may hit, it might hit my roll point. Well, then you know it. I mean, you know that, so that next morning you know what to expect, and things may be a little crazy. So may be good not to have an order in, but to be at your computer and saying, hey, I may have to roll this thing. And then then typically what I do on the price targets, the profit targets, I do put in GTC orders for those. And those are that's a simple calc to come up with that value and say, okay, put my order in, GTC order to say, buy these back at X price. But when it does get close, and if you're watching the market and you're saying, you know what, I've only been in this trade for 19 days, and I've already captured, 82%, and it looks like the market is, kind of topping out here for the time being. It's like, hey, at that point, take your profit, because if you've achieved at least 80% and you've used a stop multiple of 1.2, you've got a 4-to-1 risk-reward ratio on that trade. That's not bad, and that's not bad at all. So there are times when I will take the profits rather than just, letting it, run and run and run until I try to get the last nickel. Now, one thing I will say about taking profits is that in all my back testing, I found that if you can achieve 80% in the vast majority of cases, and when I say vast majority, it's probably close to about 95%, you will achieve a 90% capture rate. So if you're patient, you can actually capture another 10%. But I guess but just one thing, although, is that like I said, if you've captured 80+% and it is a short period of time statistically, then take the profit to free up the capital and take off risk.
Yeah, I think I saw something at Tasty Trade. They looked at butterflies, and they found that you actually had a pretty high win percent and made the most money if you took profits at 25% of the maximum versus just letting them go to expire, which is what they used to do. So yeah, there is something
Yeah.
to take profits.
Yeah, well, a butterfly is something that I could kind of see that with the butterfly trade. One thing about this type of trading is that gamma really doesn't come into the picture because you're putting these things out far enough. The DTE window is far enough out there, 40 to 65 days, and you're generally getting out of these things in 30 days or less. So usually gamma really doesn't even come into play. And so that's one nice thing too about these types of trades. But as I was starting to say is that you could do these trades without an options trading platform. I mean, you would need to know the Greeks of what you're selling, but it's really sort of that easy to do.
Yeah, I guess if you did want to trade the futures options based on this off of ES, you probably want to have some kind of stops in because they do trade 24 hours and it is nice to sleep. So you'd probably want something like that. But I can see with SPX that alerts would probably be just fine.
Yeah, I've found that alerts are pretty good. Now, what is kind of nice is to have the alerts for the profit targets, and then when you're pretty comfortable that you're not really even going to have to look at it, those can just be automatic, and they just trigger, and they buy back your short puts, and you're kind of out, and that's it. It's not a whole lot to do. One thing that's interesting though about these types of trades is that, and I've noticed this in my own trading, is that if you're making an adjustment, it usually happens fairly soon. And then after you've kind of been in the trade and you've built up a bit of theta and, volatility has, reverted to mean or come down, then usually, within probably about 10 days or 2 weeks after being in the trade, if things have settled down, that's usually going to be a winner. I mean, it's seldom, because it's like, options. It's almost like a horse race in the sense that, or well, maybe not a horse race. It's sort of like you've sold something that's perishable. So it's like you're racing against the clock here to say, okay, I hope this thing just, decays. I'm just kind of waiting out the clock here for this thing to decay. And if you've gotten some theta under your belt, then it's just kind of a waiting game to let that thing decay. And there's not a whole lot to do to it. So that the management of these trades is actually fairly simple.
I did have a question on the trade entry. So if you send out an alert, the timing of that is you see a signal, you send the alert out, and then you put your trades in, your orders in. When a subscriber gets one of these, is that the price that they should set, or can they accept a different price? They try and get filled.
Well, you raise a good point here, Tom, because there is a little bit of an art here to getting fills. The good thing is that selling naked puts in the SPX, well, let me put it this way. If someone's trading a PM account, then I know that they have some skills in terms of trade execution. I mean, you wouldn't have a PM account if you didn't have any. So I'm not too worried about that. And the good thing about having a PM account and trading naked puts is that the fills are very fast because it's a single option. And single options always trade much easier than a spread.
Yeah, you
and
become the NBVO.
Pardon?
You can become the NBVO.
Yes. So the fills are not too difficult to get. Now, what I do is I'm, of course, watching volatility and I'm watching the underlying price. And if I see certain signals that say, say, you know what, I think we are going to be looking to sell some puts at this strike in, the next, 15, 20 minutes, I mean, I'll give the heads up. At that point in time, when I send out a signal to say sell this or that, I mean, I'm not sure what price to tell people to say, because it's a matter of working the order. I mean, there's, even in signals, there's a wide enough bid-ask spread that, you're not going to just try to, I mean, you want to work it a little bit. So I don't know. And maybe this is something that will evolve in terms of how we send out the alerts to advise people what might be a suggested price. But I'm, on one hand, I'm kind of relying a little bit that people know how to work orders. That if you've got something that's let's say bid 10, ask 12, or you're not going to go in and try to sell at 10. I mean, you're going to go shoot for the mid or a little better. Maybe you go in at 11 or 11.75. I mean, I'm expecting that people know that. So that's kind of what I was thinking about that. Now on the spreads are going to be specific strikes, and the widths, of course, are going to be different. There's not a set formula in terms of how wide the spreads are going to be, because that's going to be based on my analysis of which one gives the best bang for the buck. And however, the same thing with the spreads is that people would want to work their orders. So you want to try to get. Now, I will, of course, be posting the fills that I got, and then, because see, sometimes I have to work the order a little bit, but I generally, once I've decided that I'm going to buy something, I mean, I try to go in and get, I try to get the highest dollar I can for whatever I'm selling. If I have to back off a little bit, I'll back off, and if that doesn't fill, then I back off a little more. So I take the approach that I'm trying to sell that put or that put credit spread for just the best price I can get. I mean, that's just the way I trade. So, but when I do get filled, I will, of course, be posting, and people will see, actual fills. So, but I don't know, maybe.
Well, quick question. If you go past, say, your 15, 20 minutes, do you just keep lowering your offer until you get filled, or do you just say, I'll try again another time when the next setup comes by?
No, because the setups come infrequent enough that I do try to get that trade on. That's why I roll a lot, because I mean, you can put on a trade, and you can miss a trade opportunity, a good trade opportunity to put on a position based on the fractional risk that you're trading and in your appropriate size trade for your account and your price risk, and that can be a wonderful trade. You can make a lot of money on that trade, but if you missed it, and then you said, well, I'm going to wait, and the market just takes off, for example, and you've missed that trade, it might be 6 weeks before you see another setup like that. So I do try to get that trade on. If I've done my analysis and I said, you know what, this looks like a good time here, volatility has really spiked up here, and I'm looking at the underlying price and it's hit certain triggers, then I work to get it on. So my view is that when the alert goes out, you try to get the best price you can, but once that alert has gone out, you keep working that order until you get filled. But don't let too much time go by. I mean, you're not, because these windows, like I can tell you this for absolute fact, is that the window is open for maybe, it's not like it's open for a couple hours, because you'll see that the turning points in the market happen. Sometimes that they can happen overnight, which is an interesting thing, but very often that turning point will happen either in the morning or the afternoon. And when it happens, you see it, you know it, and you have to act on it, because when the market turns, if you don't have a position on, it'll just sail right on by without you. And going back to what we were talking about earlier about how many opportunities will you see in a year, maybe 12 to 18 opportunities. So if you miss too many, I mean, you're missing out on some trades. Because see, as I mentioned earlier, is that you have to let the market tell you when the opportunity presents itself. You don't chase the market. So these are not trades that you're saying, okay, it's 50 days to expiration, so I'm putting on my weird or. Arbitrarily. That's what I do. Every 50 days, I put on a weird or. This is not that type of trading.
Right.
You let the market come to you, and then, but when it does, you have to act on it.
It reminds me of my directional trading days when there's a saying, cash is a position too.
I'm sorry, what was that?
Oh, well, cash is also a trading position, waiting for
yeah.
the right opportunity.
Oh, absolutely. Well, like you've often heard, sometimes the best trade you make is the one you didn't take.
I'm sure we all have trades we regret. So.
Oh, absolutely, absolutely. I've done them too. I've gotten antsy at times to thinking, gosh, I don't have a trade on. I really want to put some capital work. And I kind of bend my rules a little bit just to get a trade on, and then I regret it later.
Yep.
So.
Well, Bill, looks like we're coming up on an hour, so this is probably a good time to stop. I don't see any more questions. So if people are interested, this does start next week, so hopefully we'll get some signals and start trying it out. I did have that new trade history tab with the equity growth chart, and as Bill gets some more trades under his belt with the service, we'll start publishing those. So I'm sure the results are going to be pretty good, because what I've seen so far, you do a great job with back testing, and you're trading your own money and client money and doing well. So no reason to expect it won't continue in the future.
Yeah. These are real trades for real people, and so you'll get to see exactly what we're doing here. And also, I will say too is that of course this is new to me to be involved in this type of service. So there's going to be a learning curve here for me in terms of getting into a rhythm of sending out the signals at the same time I'm putting on my trades for all my different accounts, and so. There'll probably be a little learning curve there, but nothing that we won't get figured out, and hopefully people will be able to take advantage of this and maybe learn a few things along the way, and then in the future here too, I'm working on the putting some of these tools in a distributable form that. Where people will be able to actually use these and be able to do a better job of doing their own accounting for their own trades. And these can be it doesn't matter what type of trading you're doing. Like, for example, one of the tools that I've developed actually takes your Thinkorswim export file, and then it processes that file and puts it into a table to where you can actually do the analysis of saying, okay, you can actually create a trade log, actual trade log, which is then shows each particular strike that made up that particular strategy, whether it doesn't matter what you're trading, a weird or a butterfly, a condor, a calendar, whatever. and you can actually create it in such a fashion that it'll account for how much you made or lost in your calls, how much you made or lost in your puts, tabulates all your commissions as for your closed position as well as a combined open and closed position. It also calculates average prices for a particular strike. So for example, if you've bought or sold the same strike and the same expiration, but at different dates, and you want to average out your price, it'll do those calculations as well. Because it's always important to know, how much are you selling your stuff for? How much are you buying it back for? I mean, when you're short puts or short calls, or in the case of spreads, and how much are you capturing? What are you capturing in terms of the premium that you've sold? 50, 60, 70%, 80%. So that'll be, I think, a helpful tool for people. It won't be just for this type of trading. It'll be for any option trader.
Great. Well, thanks again, Bill. Really appreciate it, and for everybody for sticking all the way to the end. Jim had a little minor emergency. He had to leave, so I'll say goodbye for Jim. And with that, we'll call it a day, and good trading to everybody, and give Bill's service a try. It looks pretty good.
Okay. All right. Well, thanks, Tom. And, also, if anyone has any questions, too, they can always email me, and I'll be happy to answer any questions that people might have. And, of course, Tom, people can email Tom as well if they have questions about the service. And so hopefully, it is something that we can get going here and have it operating like a well-oiled machine and provide good service and value to people.
All right. Well, thanks again. We'll see you. Thanks,
okay.
Bill.
Thanks, Tom.
All right. Bye-bye.